discuss now the MPC's decision to hold interest rates at 3.5%. Zwelakhe Mnguni is the Chief Investment Officer at Benguela Global Fund Managers. Good evening, Mr. Mnguni, and thank you so much for your time tonight. So I suppose today's decision was very much in line with market expectations, but what is it really telling us about the state of, the economy? These are the lowest interest rates that we've seen in the country for such an extended period of time.
Thank you very much for having me. I think it was expected that the rates would be held stable. And I think the points that were made by the MPC were that the risks remain balanced in the economy. A few things that they highlighted that I think were perhaps leading indicators for us was that they basically said that growth in the third and fourth quarter, they expected to slow down, largely because of the commodity prices that actually have started to come down. I think from the middle of the year, we've seen that the commodity prices have been under pressure. So we have relied quite a lot for our currency and our current account surplus, essentially from the exports. So those exports, as the prices come down, we're essentially starting to come under pressure. So we're going to have a surplus of about 5.3% this year. They're expecting that it would be under 1% by next year. So they highlighted that they expect that the rates could be hiked by 25 basis points in the fourth quarter of this year. So in other words, in the last meeting, probably in December, they might hike by 25 basis points. And I think this has to be seen against the backdrop of the United States that has held rates steady, but has warned the investors in the community of the U.S. that they will be starting to cut back the bond buying program. So against that backdrop, many of the emerging market countries would probably start raising their rates ahead of the U.S. to basically try and make sure that the differential in interest rates is not too high to a point that their currency can depreciate materially and therefore feed into inflation.
Part of the decision to, cut interest rates initially was to help South Africans, businesses and people to, to recover from the impact of the COVID-19 pandemic. Are we at a point yet where we're able to fully assess what the impact of this has been on households?
The assessment is that, that has slowed down the recovery, the economic recovery. So we went into COVID, which brought us a whole lot of challenges. And out of that situation, we had an added challenge of the disruptions and the violence that we saw in our country. So what it did is probably delay the investment that could have taken place earlier, would have been delayed as a result of people not having the confidence that there is stability. I think those things have been addressed to some extent, but certainly it is a risk that has been added to the issues of COVID-19. I think the bigger issue, the disruptions aside, the bigger issue is the issue of the vaccine, the rollout of vaccine across South Africa and many other emerging markets. That will remain an issue that will slow down the economy because you don't get a full benefit of a fully opened economy when you still need to vaccinate people and you can't operate at full capacity.
Let's talk about then the impact of the unrest and how it was assessed and reviewed by the Reserve Bank.
The Reserve Bank said the impact was that investment would be slowed as a result of that. And in other words, so if you think about the accounts of the economy, so you've got the households, you've got the public sector, you've got the investment that comes through, and then you've got the trade leg. So those four legs, if you look at it, what South Africa has been struggling with is that the household leg without employment, you don't get that additional growth that you need unless people take more debt. The public sector has also been under debt because it's transferred some of the challenges in the private sector to the public sector by providing relief and the benefits that they've provided. And then the investors, they work on sentiment. So they want to come into the country and invest on the basis of they have confidence that there's a bright future in the country, growth would be achieved. And what the impact of the disruptions and the violence did is that it affected sentiment and confidence in the country. Fortunately, we had the exports and the commodity prices that were rallying, and that has bailed us out now. With the commodity prices coming under pressure, what you need to fall back on is the three legs, and those three legs are not looking good. That is why the growth outlook for GDP is kind of muted from where it was the last time.
Zwelakhe Mnguni is the Chief Investment Officer at Benguela Global Fund Managers. Let me thank you so much for your time tonight.